Hello and welcome to the latest Moneymakers Investment Trust podcast. I'm Jonathan Davis, and this week, again, after a 2-week absence, I'm delighted to say I'm being joined by Simon Elliott, the Head of Investment Trust Research at Winterflood Securities, who's come back tanned and fit from his holiday, ready to tell us all about what's been happening this week, even though I have to be honest and say that this has been a very, very quiet week by normal standards. There hasn't been a huge amount of news, and many of the main market players are still on holiday, of course. So there is an important meeting coming up this weekend, a Jackson Hole meeting, where the central bankers will be talking about where we're going in the world. But let's kick off as normal, Simon. First of all, welcome you back, and then let's kick off by asking you what has happened in the market this week.
Well, it's good to be back, and as you correctly observe, it's been a relatively quiet week, a nice one to slip yourself back into action. Certainly the UK market for the first 4 days of the week is up in positive territory, probably up about 0.7% to the end of Thursday. And the investment company sector is broadly in line with it. Though actually the sector average discount has widened out a little bit this week, probably started the week at about 2% or so, and finds itself nearer to 2.4%, 2.5%. And just to remind people in terms of the year-to-date numbers, well, the UK market's probably up about 15% so far this year, and that's ahead of the FTSE World Index over the same time parameter. And investment companies have lagged. They're probably up about 10% or so. But you're right, it's certainly a quieter week, and we can see that in terms of the amount of shares being traded through the London market. I did read somewhere that volumes were down about a third over the 30-day average this week. And certainly I can tell you in the investment company sector that the average daily volume so far this week is 25% lower than the average over the previous 6 months, so significantly lower. But you're absolutely correct that the market is very much focused on Jackson Hole and the speech that will be made today. And really the question, what are the Federal Reserve likely to do with regard to tapering the stimulus? Obviously, economic data is broadly positive, but the impact of the Delta variant is a key concern. But there has been some good news in the marketplace this week. In terms of global dividends, they're predicted to return to 2019 levels by next year, though clearly in the UK we are quite focused on the disruptions to supply chains. And I see that McDonald's has run out of milkshakes as well, so some mixed economic news there.
Indeed. Well, I think I can live with the last piece of news myself, but it's obviously a problem for some people. We should mention, of course, also there have been these terrible scenes in Afghanistan this week, but I think this is exactly an example where this dominated the news headlines, but it has only a marginal impact on the financial markets. There will be obviously some longer-term strategic issues arising from this in terms of, balance of power globally and so on, but it's very hard to translate that back into what it means for the financial markets. So I think they've largely shrugged off that news, though one can, of course, only have sympathy for those who are caught up in this very unfortunate set of circumstances. Let's move on and talk about some corporate activity. There has been a little bit this week. We can start off by talking about the Aberdeen Asian Income Fund. That is AAIF is the ticker. They've had something to say about their plans. What can you tell us about that, Simon?
Yeah, so 2 developments for Aberdeen Asian Income Fund. They published a circular with proposals to become a UK tax resident and join the UK's investment trust regime. What does that mean? Well, not an awful lot, really, to ongoing shareholders. Basically, the majority of UK traded investment companies are what we call onshore, so they're domiciled in the UK itself, but a significant number are domiciled in the offshore or in the Channel Islands, and that's the case with Aberdeen Asian Income Fund. It's a Jersey domiciled investment company, and it's in good company, actually. So within its peer group, you'll find funds such as Henderson Far East Income, are also based in Jersey. They're obviously traded in the London market. I mean, for ongoing shareholders, it doesn't have any real implications, but it does need approval before that move can be made. What will be more notable is that they're also looking to change their name. And I think this is something that we talked about in months gone by. Aberdeen Asian Income are looking to change their name to Aberdeen Asian Income Fund Limited, but the difference being that Aberdeen will be spelt without any vowels. So this is the first of the Aberdeen Standard Investments stable that's put its head above the parapet. And I think it's quite notable that in the statement, it did make the point that The migration of the tax residency is not conditional on the change of name approval. In other words, the two things will be treated separately.
Yes, well, that's very interesting. So just to clarify that, as we know, Aberdeen Standard decided to go for this, for branding purposes rather than anything else, marketing purposes, to change the name of the fund management company to ABRDN, as you say, with no vowels and no capital letters either. So this is back to the nursery, you could say. I must say, if I was on the board of this trust, I would be thinking this was largely irrelevant, I would say, and possibly an irritation. It's interesting to see how the shareholders vote on this one. You get a chance to vote on the change of name. Interesting to see whether the shareholders will reject this new abbreviated, vowel-less, capital letter-less name. But just on this point about the residency, it won't affect shareholders here. So why is the board of this particular trust doing it in that case? Why are they making this change to bring it back to the UK regime?
Yeah, no, it's a good point. And actually, it kind of goes in the face of what we've seen probably over the last 10 years, possibly even longer, where those investment companies, perhaps with a yield requirement or a yield mandate, and possibly with quite a significant amount of overseas income, have domiciled themselves offshore just because it adds greater tax efficiency. This move is coming the other way. It's coming back onshore. And in the blurb around the announcement, they say that UK tax residency will enable the fund to benefit from double taxation treaties, lowering withholding tax applicable to dividends received, increasing revenue available for distribution. So I guess the bottom line is they've sat down and worked out that it makes more sense to be onshore than offshore. And that's, as I say, in contrast to the pattern that we've seen over the previous 10 years.
So that sort of implies to me that they think they can draw more on reserves in order to sustain their yield, basically. Would that be right? They've got more reserves to draw on. Would that be the logical implication of that?
I think it's more to do with the income as received. I mean, obviously, when you get paid by companies around the world, there can be friction costs, obviously taxation being one of the most obvious ones. And where you're domiciled does make a difference in that calculation. So I guess they've received advice from their specialist advisors and their tax accountants that actually to be onshore makes sense for them. I mean, what will be interesting will be to see whether this starts a trend for those overseas equity income type plays, of which there are a number, as I'm sure you're aware, whether they also look to seek to come back onshore over the next few years.
Indeed. So let's move on and talk briefly about BH Macro, which has BHMG and BHMU, the two share classes, $1, £1. What have they had to say? We know they're completing a merger with BH Global. We've talked about that a lot in the last few weeks. So what's the update they've provided on that score?
Well, this has all basically happened now. So BH Macro is the ongoing vehicle, and shares have been issued to those people in BH Global who elected for the share option. And we were basically waiting for the NAV as at the end of July, 31st of July, which was duly published a day or two ago. So basically, the new shares in BH Macro will begin trading on the 31st of August, so Tuesday next week. And from that moment on, there is just BH Macro. But what's interesting, I think, is that its total net assets will come in at 874 million, which is a decent size investment company. And I think when we've talked about this in the past, we made the point that the two together, so BH Macro and BH Global, had assets in aggregate of $1 billion. We knew there was going to be a cash option, there was a tender offer, and we knew that there would be some shrinkage. But to kind of start off with 874 million and it's trading on a significant premium, I think gives BH Macro and its kind of new lease of life a very good start.
And of course, not bad for Brevin Howard also, who now have the benefit of the higher fees that they've managed to negotiate along the way here. So that's very interesting. That's gone through. And then you talked about the size of this trust now, and it's getting pretty close to the same size as Third Point Investors, who have also been in the news this week. This is a hedge fund, as you know. And look, tell us what's been going on there. This has been where we've had a bit of a battle between some shareholders and the board. What's the latest on that particular saga?
And it is a saga. I think it will be an ongoing saga. You'll remember back in May, I think we first discussed this when a gentleman called Tom Trina, who's the head of research at Asset Value Investors, wrote a public letter to the board of Third Point Investors very unhappy with the way that the company was going, particularly the way that it was looking to tackle its discount, accused its investment manager, Daniel Loeb, as displaying contempt for shareholder rights and good governance. So that was the start of the battle, really. More recently, asset value investors plus 3 other shareholders tried to requisition the board. That was unsuccessful. The board pushed back and suggested that they'd been advised that the requisition at that stage was ineffective. That's a legal definition because it infringed on the board's ability and obligation to manage the fund. So asset value investors are undaunted, and they've come back again with the 3 other shareholders. So collectively, they own 17% of the share capital and over 10% of the voting rights. They've requisitioned again, and this requires the board to hold a non-binding advisory vote for an ordinary resolution to allow shareholders to redeem their holdings on terms that matches other investors in the underlying master fund. And, as before, asset value investors made the point that they continue to harbour, and I quote, grave concerns as to the integrity of the process of Third Point Investors' strategic review and its conclusions. So this battle rolls on.
Yes, and it is a curious one, isn't it, in a sense, because if one looks at how Third Point Investors has been performing, I mean, if you look at its results, I'm looking at the ASC numbers here, 5-year share price total return, 116%. That's not unreasonable, you'd have to say. And over 10 years, 244%. That's not unreasonable either. You'd say that's pretty good. That compares very well with others in the sector, and indeed in most other sectors as well. And the discount, I mean, one of the issues being around the discount, and that'll also come in a little bit. So do you think that the asset value investors and their other related parties are going to win something substantial out of this or not?
Well, it's a tricky one, to be perfectly honest, not least because it's quite a complicated voting structure as well. And I think we've discussed this in the past, but 40% of the share capital in Third Point Investors is in the hands of a trustee, and that was put in at launch because of a large number of US shareholders. It had to be some kind of protection in place. In addition, Daniel Loeb, the aforementioned investment manager, he owns 17% of the company. So really, those 2 blocks of votes hold a huge sway. And the reality is that unless those blocks are not voted, that it's very difficult to see how asset value investors or anybody can really kind of affect change or push the board in a direction they're not happy with. It's interesting, we did see at the AGM for this fund back in early July that 37% of shares voted were against one of the directors, who also happened to be the chief operating officer of Third Point. So in other words, he was a connected director, he wasn't independent. And also 23% of the shares voted were against the proposed exchange facility that the board had come up with. This is their mechanism that they'd put on the table in order to alleviate the discount. And again, it's a slightly complicated one, but essentially allows shareholders who have more than $10 million to convert into the equivalent Cayman fund at a 7.5% discount. So there's a kind of natural arbitrage there. And that will actually happen in October this year. But again, a significant number voted against that. So difficult to see how this all plays out. I think the board will say, well, look, the discount has moved in. We've put a number of measures in place. We have received shareholder approval for that proposed exchange facility. Let's see how it all turns out. But again, it doesn't look like asset value investors are backing down either.
Yes, and it's fair to say, I think, that this is a complicated structure, which is often the case with hedge funds and so on. It's not a plain vanilla kind of simple shareholding structure for the reasons that you've mentioned. And it doesn't seem to me that asset value investors are sort of winning at the moment, though the discount has come in. What have you got the shares trading on at the moment, Simon?
You make a good point. So Third Point Investors probably trading between an 11 and 12% discount. Let's call it 11.7 to be more precise. And that compares with an average over the previous 12 months of about 17, although it has been as wide as 28% in that time. I'm sure those involved with Third Point Investors will point to asset value investors' own investment trust company. So AVI Global Trust, a very long-standing investment trust previously known as British Empire Securities, and that's actually trading on about a 10% discount at the moment, so not too dissimilar to the level that Third Point finds itself on.
Yes, I'm sure that may be a point that they make in due course. So a little bit of put your own house in order, perhaps, might be something they'd be tempted to say anyway if you were sitting at Third Point Investors. Okay, well, let's move on and talk about some fundraising. Obviously, this is August, a very quiet market, so not normally a time I guess you'd expect to see a lot of fundraising, but there is one trust which is going to go out there and try and raise some money, and that is Target Healthcare REIT, THRL. What have they done?
Well, they've announced that they're looking to raise around about £100 million, and that's under an existing placing programme. Effectively, they've identified a pipeline of acquisition opportunities. The fundraising will be done at a price of 115p. That represents a 6% discount to their closing price just prior to when they announced this fundraising, and a 4% premium to their last reported EPRA NAV. The placing closes on the 9th of September, so we'll find out in a few weeks' time how they've done. But certainly the last time they came to the market to raise additional capital, that was back in March. At that stage, they raised £60 million, and that was oversubscribed. And that was at 111p per share, so this price is north of that. And they provided a bit of detail in terms of their pipeline. It totals £230 million. It consists of 18 operational modern care homes, and they're in advanced negotiations for a debt facility, £100 million of long-term debt, in order for them to be able to fund that. So they obviously are quite positive on their chances.
So there's a couple of trusts in this particular segment, the UK healthcare segment. What's the relative performance of those two? I mean, which is the bigger and which is trading on the wider premium?
Well, the most comparable investment company to Target is Impact Healthcare REIT. Both Impact and Target are trading on premium ratings. The numbers I've got, Impact are probably on about a 7% premium. Target are probably on about a 10% premium. Target has the longer standing of the two. It's got a market cap just above 600 million, whereas Impact Healthcare is probably about £410 million market cap. In terms of their dividend, their net yields, certainly on a historic basis, Impact is coming in at 5.5% and Target is in at 5.7%. And actually, they provided some detail over their target dividend. They reinstated that for 2022 at 6.76p, and that represents a 0.6% annual increase and a 5.9% yield on the issue price. So obviously a yield, a key part of the story.
And these premiums, I mean, they've been there for some time, have they not? Have they weakened at all, like some of the other alternative asset trusts have done recently, or are they still trading roughly where they were?
No, I think the premium ratings have held up quite well on both of these funds, actually. So, again, Impact probably traded on an average premium of about 1% or so over the previous 12 months. As I said, it's 7 now. Target average premium rating over the previous 12 months was 6, so it's on about a 9-10% level now. So, again, I think the ratings look relatively robust at the moment. It'll be interesting to see how the fundraising plans go for Target.
Okay, so we've got a few results to talk about. We'll move on to those now. Let's kick off with JP Morgan American, JAM or JAM today. We hope, and JAM tomorrow. They produced their interim results for the 6 months to the 30th of June.
That's right. And, decent, solid set of results here. So the NAV total return was up 15.4%. That compared with a rise of 13.9% for the S&P 500 index. Share price terms not quite as good, actually, broadly in line with that benchmark index, up 13.9%. And that reflects the fact that discount widened slightly. And that's despite the fact they actually bought 2.5 million shares back in the period, over 1% of the share capital. But the main drivers of outperformance were sector allocation and gearing, which averaged about 5% or so in that 6-month period. The large cap portfolio outperformed the S&P 500, but actually their small cap allocation dragged a little bit during that time. But it is an interesting fund, actually. So back in June 2019, it adopted a hybrid value and growth approach. It's certainly in terms of its large cap portfolio. So for those people unfamiliar with this, because it is a little bit different, there are two managers, Tim Parton and Jonathan Simon, that are both hugely experienced New York-based investment managers, but one's very much a growth manager, that's Tim, and one has a kind of value approach. And the idea is that both of them have their kind of 20 best ideas. So the large cap portfolio consists of 40 holdings, 20 of which are growth stocks and 20 of which are value stocks. And the idea is, by adopting that hybrid approach, that you negate the style bias that obviously happens from time to time in the marketplace. And the intention is that over the long term, by taking kind of style off the table, it's really the stock selection that drives the performance. And certainly if you look at the performance year to date and compare it with, Bailey Gifford, US Growth, for instance, which has a very strong track record, but as the name would suggest, quite a growth investment approach, then JP Morgan American has outperformed this year to date.
Yes, it's done very well. I actually, one of these trusts, I don't actually know the history, but I see that it was launched in 1881. So it's one of the few that's actually survived this over that long period. And its performance has not been at all bad, has it? I mean, as you say, you mentioned Bailey Gifford US has done exceptionally well since it launched, but the long-term track record of this particular trust has been pretty reasonable. And perhaps one of the few that actually belies the general observation that UK fund managers have generally struggled to do well in the US market. Can you remind us what its original name was, Simon? Can I test you on that?
Oh my goodness, no, but you've obviously got the answer at your fingertips to embarrass me. When I joined the sector, it was called Fleming American back at the start of the millennium. But go on, what was it in 1881?
Well, I have to be honest, I don't know. So...
Oh.
Okay. So you turn the tables on me there. But maybe it was a Fleming Trust, was it? I mean, Fleming did start their investment trust back in that sort of period. Oh, my God, we're totally short of information here. So I'll have to see whether I can find out before the end of the podcast what I should have known before I was stupidly asked the question. Okay, so let's move on and talk about another JP Morgan investment trust. So this is the JP Morgan US Smaller Companies Trust, JUSC. They've also had interim results for the same period, and we can contrast and compare. What were the results of this trust like?
Well, they underperformed. Their NAV total return was up 10.9%, and that compared with a rise of 16.2% for the Russell 2000 index. Share price terms, not as good, actually up 7.8% as the shares moved from a 2% premium to a small discount, although they did issue new shares during the period. So the story here is one of stock selection. That was the primary driver of underperformance, although gearing was positive. And really the story from the investment manager is that it reflects the focus on quality companies. And this is a similar story to that we found for a number of UK smaller companies that obviously, particularly in the first quarter of this year, when we really did see that kind of vaccine bounce, some small cap managers have kind of likened it to being the dash for trash. Some more cyclical, lower value or lower quality companies, in their view, benefited during that period, and those with a quality bias have struggled. And I suspect that would be the claim for JP Morgan US smaller companies. But if you actually look in the portfolio and how it's done this period, well, it's consumer discretionary, technology and basic materials sectors have detracted the most. Conversely, the stock selection and sector allocation within healthcare and utilities benefited performance. It's also worth noting that the manager, and actually I think he's been the manager since 2009, Don San Jose, obviously mispronounced terribly, but he's actually taking on the additional role of Chief Investment Officer at JP Morgan Asset Management's US Value Team. And actually his small cap team will move across this group, although that reorganization is not expected to change the management of this particular investment trust.
So, I mean, there can't be that many trusts to compare this one with, but what can you tell us about its performance more recently, over the medium term?
Well, certainly over 5 years, it's generated an NAV total return of 90%. And just to put some comparative numbers on that, the Russell 2000 index, and that's normally seen as the kind of benchmark for US smaller companies, that's up 72%. So it has outperformed over that 5-year period. Probably its nearest competitor is Brown Advisory US smaller companies. And this, we've talked about this in the past, but this was previously in the Jupiter stable. Brown Advisory only took over the management of this company about the turn of this year. So a very short period of time really to compare it with. And just over the last 6 months, Brown Advisory is slightly ahead. But as I say, a very short period that they've been responsible for that one. Okay,
so we'll move on and we'll talk about some specialist trusts now. Let's kick off with the BBGI Global Infrastructure. BBGI is also the ticker. Interim results for the same period. And what have they reported?
So the NAV was up, but only very slightly. So it was up 0.03% to 137.8p. BBGI Global Infrastructure's assets stood about 918 million at the end of June. And really the story here is that the increase in the UK corporate tax rate detracted from that NAV performance. And also they had some foreign exchange losses as well, or certainly unrealized losses. The weighted average discount rate that they use across the portfolio to value the assets, that stood at 6.56%. That was down from 6.77% at the end of December, and that would have benefited the valuations. But in terms of actually how the portfolio is performing, then cash receipts were ahead of expectations. And in fact, the board have obviously taken some confidence for that because they've restated their dividend target for this year of 7.33p. And that represents a 2.1% increase on last year. And actually, they provided guidance for next year and for 2023 and looking to increase that dividend by 2% for both those years. The cash dividend cover for the first 6 months of this year came in at 1.55%, although in the analyst call accompanying the results, Frank Schramm and Duncan Ball made the point that tends to be a little bit front-ended loaded, so they'd expect to see that nearer to about 1.2 times covered by the year end. But basically, the story is pretty solid. There's been no material adverse operational or financial impacts from the pandemic. They continue to build the portfolio out. So 4 operational assets were acquired for £75 million, and they were all based in the UK and backed by public sector counterparties. And they repaid what modest cash borrowings that they had back in August, and that followed some fundraising in July. But this is a portfolio of availability-based infrastructure products, probably about 51 or so. And certainly the mantra seems to be boring is beautiful. This is ideally meant to be a steady performer.
Yes, and it does trade on a significant premium. As you said, I think it's one of the biggest, if not the biggest, in the infrastructure, general infrastructure space. Why do you think that is? How does it compare in terms of yield? Is it a yield story that's resulted in the premium, or is it some other factors?
Well, the yield is coming in about 4.1% on historic basis. And obviously, we're going to see those dividends increase, assuming the target's hit, by 2% or so over the next 2 or 3 years. But I think really that premium rating reflects the underlying portfolio. And as I said, it's an availability-based infrastructure products. And just to be very clear, what that means is that as long as those projects are available, as the name would suggest, or operating, then the investment company gets paid. So there is no economic sensitivity in this portfolio. So if you look through the list of what they own, it's things like bridges, health facilities, educational facilities. It's very much kind of public sector orientated. And they have a pretty solid track record. I think it's coming up for about 10 years that this fund has been up and running. And actually they're self-managed as well. That's probably worth noting. So that's another differentiator. So there is no kind of third-party investment manager agreement in place here. Everybody is employed by the investment company.
There's been a lot of fundraising in the infrastructure sector, as we know this year, particularly by some of the other trusts in the sector, which are now bigger than BBGI is, even though they've been around for a shorter period of time in some cases. Do you think that the fundraising in this particular sector is going to continue?
Yeah, no, you make a really good point. I mean, BBGI, just to be clear, raised 75 million back in July. So they've been back to the market relatively recently, but they make the point that pricing is very, very competitive in infrastructure in general, that a lot of what they would consider to be high quality assets are highly sought after. Pricing can get quite extended. So they're very, very careful in terms of how they deploy new capital. And they make the point that as a self-managed infrastructure investment company, they're not really incentivized to grow assets as you would be if you were an investment manager earning a percentage of the pot. So they would consider themselves to be very discerning. They've also got agreements in place with a number of constructors. And so they have some visibility on pipeline, assuming those assets are ready for them to invest in. So I think they've identified a number of opportunities. So could they raise additional money in the future? It's certainly a possibility in order to meet those kind of pipeline requirements. Although, as I mentioned, they have paid off their debt relatively recently. So one would assume that the normal pattern of events is that when people come to make new acquisitions, they tend to do it on a credit facility, or they tend to use loan financing initially before then having to come back to the marketplace. But overall, I think the ratings in the infrastructure space tell you that these are assets in demand, that people are still looking for income. They're still looking for asset classes that are uncorrelated to broader markets, be they equities or bonds. And therefore, infrastructure still would appear to have a place in many people's portfolios.
Yes, I think that's an interesting point you make about the difference between a self-managed and externally managed trust. It obviously is the case if you have what we call an ad valorem fee, which is based on the size of the company, then there is an incentive on the fund management company's part to grow the trust because they get paid more in terms of fees, though in many cases these do get trimmed the bigger the company gets. They get tailored down a little bit, but it's still a net positive. So that's something perhaps that investors should watch out for. Let's move on and talk about Invesco Bond Income Plus, which has the ticker BIPS, BIPS. They've also had some interim results.
That's right, interim results for the 6 months again to the end of June. In that time, they generated an NAV total return of 4.3%, and that compared to a rise of 3.3% for their benchmark. In share price terms, it actually did come in at 3.3%, and that's just a reflection of the fact their discount widened slightly from 2% to 3%. The dividend for the period equated to 5.25p, and so therefore they're on track for a full year dividend of 10.75p. And in fact, their annual dividend target of 11p for the following 3 years is considered achievable and sustainable. And it's worth noting that this investment trust previously was known as City Merchants High Yield and merged with Invesco Enhanced Income relatively recently, actually. So it's increased the net assets to over £330 million. But it's managed by a chap called Rhys Davies. He's been responsible for the portfolio since 2014. And again, the investment managers report, there's some good commentary about what he's been doing and obviously some good insight into the bond market. Been taking a bit of money off the table where he thinks the balance of risks has changed over the 6 month period. So taking some money away from retailers, and he's responded to the inflation risk as well by keeping certainly those bonds with interest rate sensitivity low and sticking to higher yielding bonds.
Right. So when we talk about a bond income plus, this is a new way of describing a high yield investment trust, I guess. That's perhaps the new way of talking about it. That people can't really claim that a yield of whatever it is actually high yield anymore when the numbers are so low. So this is the kind of trust that you might own if you're interested in a kind of low but hopefully steady yield. Is that right? I mean, how does the yield on this one compare to others it might be compared against?
So we've got the yield on a historic basis at 5.6% at the moment. But as I said, it's probably worth looking at that annual dividend target of 11p, assuming that they manage to hit it over the next few years. But the average yield in its peer group is probably about 5% or so. So that there is a range. We've got it certainly in the debt, in the kind of loans and bonds bucket. So there's a few funds there. We probably don't talk about this area of the marketplace too much, but better known investment trust companies, probably Henderson Diversified Income, and that has a yield of just over 5%. M&G Credit Income, that's at the lower end, about 3% or so, 3.1%. And MB Global Monthly Income, that's coming in about 5% at the moment. So, broadly speaking, it's in that kind of ballpark.
Okay, let's move on and talk about Pershing Square Holdings, PSH. This has been very much in the news recently for a whole number of reasons. You've probably missed part of this, another endless saga involving a hedge fund trust. We talked about Third Point Investors with Dan Loeb. This is Bill Ackman's investment trust. He's another well-known American hedge fund manager, and they at least have produced some interim results. And they had a spectacular year last year. How have they done so far this year?
Yeah, quite a year, I think it'd be probably fair to say. So far, in terms of their NAV performance anyway, interim results for 6 months to the end of June. In that time, they generated an NAV total return of 7.3%, and that compared to a rise of 15.2% for the S&P 500. The share price total return came in at 4.7% as the discount widened out a little bit. So the underperformance was attributed to mark-to-market losses on Pershing Square Tontine. So in other words, the SPAC that I think you've been discussing in recent weeks, and also investments in Fannie Mae and Freddie Mac as well. I think everything else was in positive territory, but certainly those three detracted from the numbers. The results also provided a little bit of an update in terms of the lawsuit that's come in, alleging that the SPAC, Pershing Square Tontine, is operating as an illegal investment company. So they're looking to launch a new SPAC structure, is my understanding. That's certainly been proposed, although they're waiting SEC approval, and that would mitigate the impact of the lawsuit. They also provided some detail on the fact that they've invested $2.5 billion in Universal Music Group, and they've got an option to increase that position as well. And in terms of more general portfolio activity, they've exited Starbucks in the period, and they've invested in Domino Pizza. So a few things going on here.
Indeed, there are. And obviously this story about the SPAC is quite interesting for those who are interested in that kind of rather exotic, if you like, clever clogs activity that hedge funds like to specialize in. But it does seem that Bill Ackman has got himself in a little bit of trouble with the SEC and the lawsuit by trying to be, I think I described it as too clever by half, but that's just my point of view, of course. I'm sure he knows what he's doing. But anyway, the discount has widened again. So that's quite interesting. It's back out to what? What have you said, 25%, that sort of thing? And its future remains a little unclear, I would say. What are your thoughts about that?
Well, you're absolutely right about the discount. I've got it on about a 29% discount at the moment, and that compares to an average of about 26, 27% or so over the previous 12 months. So, I mean, it does tend to wing around a little bit over that previous 12-month period. It's gone between about a 19% discount and a 36% discount. And bearing in mind that this is an investment trust company with a market cap of over £5 billion, and that's in sterling. You don't find too many with that kind of wide discount. So it begs a few questions. I'm sure people like asset value investors have had a look at it, those people who have a more value-orientated investment style. But it's worth remembering that Bill Ackman himself does own a big chunk of the equity of this one. But even so, I suspect, and in fact they did mention in the interim results, that the discount is a source of annoyance for them. I think it would be fair to say.
Yes, I think they have said that in the past. And without going through all the tortuous details of the SPAC, I mean, what it does mean is that Pershing Square Holdings just ended up committing to make this very large investment in Universal Music, which is going to be quite a big chunk of its asset base, rather than putting it through the SPAC as it originally intended. So that's very much changed the nature of the portfolio, I would say. And it remains to be seen what steps he's going to take to deal with that once that investment is actually vested in, I think it's next month that the Universal Music Holdings is meant to come to fruition, that acquisition. Okay, so let's move on and talk about private equity. We've got BMO Private Equity, BPET is the ticker. They've had some interim results for the first 6 months, and they've done pretty well, I think. What can you tell us about that?
Yeah, no, I think that's spot on. They have done well. So in that 6-month period to the end of June, they had an NAV total return of 15.4%. In share price total return terms, it was even better, up 39.1%, and that reflected the fact that the discount moved from about 37% to 24% in that time. They benefited from a number of valuation uplifts, so holdings such as Weird Fish, which is apparently a clothing company, Hughes Gray, which is a builder's merchant, and Pet Network. They all saw material uplifts during that 6-month period. They also saw a very high level of realizations, £69.5 million. And I think that represented something like double what they saw for the whole of 2020. And that included a realization of a company, a co-investment they had in a company called Dogmatics that they got back about £31 million for. So lots of portfolio activity on the realization side. They made a couple of new investments, and actually more since the end of June. And they've also paid out quarterly dividends as well. So they do have a bit of a dividend on this one. So on a historic basis, they're yielding about 3.7% at the moment. So Hamish Nair, long-standing investment manager of this one, certainly quite a upbeat, bullish investment manager's report, as you might expect, given this set of results.
Okay, well, let's move on and talk about HG Capital Trust, another private equity trust. And what have they been had to say?
Yeah, well, we await HG Capital Trust's interim results as at the 30th of June. They're due to be published on the 6th of September. But actually, what they have announced in the previous week or so is a number of investments. They've certainly appear to have got their checkbook out. So I'll just run through these quickly. But I think the point is that they give you some insight into there's actually quite a lot of activity going on across the private equity sector, and in particular for HG Capital, and also the nature of the type of companies that they're looking to back. So they're investing £20 million in a company called Managed Markets Insight and Technology. And as the name would suggest, this is very much a kind of tech play, but it provides commercial intelligence and predictive analytics to the pharmaceutical industry. They're getting £9 million at work in the investment of a company called Risk Allies, which is a US risk-centric wealth management platform that services financial advisors, enterprises, and asset managers. And they're also looking to make a £24 million investment in a company called Cerella. Hopefully I pronounced that correctly. And that's a global financial automation and business-to-business payments software company. So tech-enabled businesses are very much to the forefront of what HG Capital are looking to do.
Indeed. And so before we could perhaps compare how these various trusts are trading, why some like HGT are trading at a premium and others are trading at a discount, let's move on and talk quickly about Pantheon International, PIN, also in the private equity sector. What have they had to say?
Yep, so they provided a monthly NAV as at the end of July. That was up about 0.4% or so from the end of June, though, to be fair, I suspect the valuations, the underlying valuations, most of which will be as at the end of March, I would imagine. But basically, they saw some positive valuation gains, and that was despite the fact that foreign exchange movements were not in their favour during that period. But in terms of the level of activity, I think the story is consistent across all these private equity guys that overall things are pretty positive at the moment, that they are seeing good deal flow, both in terms of realization, so actually selling investments they own, and in terms of opportunities to deploy new cash. And certainly, you look at Pantheon International, in terms of their balance sheet, they've got net available cash, or they did have at the end of July, of about £200 million, with their private equity assets over 1.7 billion. So they've still got a bit of firepower there.
And then finally, we can look at Princess Private Equity. That's ticker PEY. They've announced a transaction.
That's right. It's another sale. This is a company called Strave. It was previously known as SPI Global, which is a global provider of technology-driven content and data solutions. And so basically, the transaction valued Princess Private Equity's stake in about just short of $19 million. And that was above the carrying value, which was nearer to about $18 million. So they get a nice uplift from that. But again, they gave us an updated NAV as at the end of July. That was up month on month, about 0.6%, again, reflecting positive portfolio developments, though currency movements in this particular instance were flat. But what I think is also interesting with Princess Private Equity is they actually received quite a lot of cash back from some of their underlying realizations. So they had holdings in a company called International Schools Partnership and another company called Global Logic, and they received over 100 million euros from both those investments.
Okay, so just finally then, looking across the sector as a whole, the discounts have been coming in, which is good news for shareholders generally. But these four that we've talked about, how do their ratings compare?
So HD Capital Trust, I think, as you mentioned, is sitting on a premium of probably about 22% or so. Though it's worth noting we are waiting to receive the NAV as at the 30th of June. So we're working off an old NAV at the moment. And one might expect that the NAV to have increased in the interim period, so that premium rating might not be quite as high as it would initially appear. Princess Private Equity on a discount of about 9% or so. BMO Private Equity, I mean, the rating on BMO Private Equity has been incredible, really. In the previous 12 months, it's been as wide as 41% discount. It's averaged 23% discount. At the moment, it finds itself on a 7% discount. So considerable amount of discount volatility. So if you've played that correctly, you'll have done quite well just in terms of the discount tightening. And obviously, as I mentioned, there's been some very good NAV growth as well. And then the other one I think we talked about was Pantheon International. That's sitting out on a 19% discount, and that compares with an average of 22% over the previous 12 months.
Okay, so one of the points you mentioned before in the past has been that there is a difference between some of these private equity trusts that invest in other funds and those that invest directly in individual companies. Is there any pattern in the difference in the discounts between those two different types of private equity trust?
Well, I think as a rule, there is quite a lot of variation across the private equity field. As a rule of thumb, the more concentrated the portfolio, coupled with a strong performance record, that probably helps. That leads you to a higher rating, and that would certainly be the case for HD Capital Trust. Conversely, those are more diversified portfolios, so those fund of funds, they seem to be struggling a little bit to gain interest. And we talked about Pantheon, but equally Standard Life Private Equity, ICG Enterprise, HarbourVest Global Private Equity. These are all very respective investment managers, but they're all trading out around 20% discounts. So they certainly are wide on a historical basis, but in each of those instances, I think they have tightened a little bit. To your point earlier, they have tightened in recent months.
Finally, then, we're going to quickly look at a couple of property investment trusts where we've had some news this week. First of all, there's been an update from GCP Student Living. That's DIGS is the ticker. Obviously, there's been a lot of talk in the media about what's happening with students and the outlook for the coming years, how they're going to be taught and so on, and the numbers after coronavirus. What's the update from GCP Student Living?
Well, they've announced this week, just in terms of where they are with regard to bookings, following the A-level results day on the 10th of August. So bookings, unsurprisingly, have picked up. So as at the 20th of August, bookings for the 2021-22 academic year stood at about 56%. Now, that compares with 95% at the same point in 2019 and in fact 63% at the same point in 2020. So the team there continue to anticipate the booking season for 21-22 academic year certainly being condensed and back-ended, but total bookings are expected to be impacted by global travel restrictions. But again, it's just worth noting on GCP student living that we have got this recommending cash offer on the table. I think we talked about that in weeks gone by. So the share price of this one has got support from that cash offer on the table.
Yes, so depending on what happens, that could turn out to be quite a timely or well thought out acquisition proposal if they can see further than perhaps the trust itself is able to see at the moment in terms of future bookings. Finally, let's talk about Warehouse REIT. WHR is the ticker there. They've had a trading update.
They have, and they're very busy. I think it's probably the headline here. They made 4 acquisitions for a total of £13 million, and that reflected a blended net initial yield of about 5% or so. They've also exchanged contracts to acquire 16 acres of land, joining the existing Radway Green multi-let estate outside Crewe. There have also been 20 new lettings completed at 7% at the end of March expected rental values. So as I mentioned, lots of portfolio activity with Warehouse REIT. In terms of their total occupancy level, that actually was down from about 95.6% at the end of March to 94.2% at the end of July, just down slightly, but effectively there's quite a few units there that are under refurbishment or under offer to let. In terms of the total rent due on the June quarter date, that came in at 94.5%, had been collected as at the 17th of August, and they expect that to continue to increase in line with the previous quarters. Okay,
so that brings us, I think, to the end this week, Simon. We've say it's been an abbreviated week in terms of the announcements that have been made compared to some weeks. But what do you think? When does normally the market start to pick up? You said the trading has been quiet this month and people are on holiday, obviously. So is it normally we could expect the first week of September to see volumes pick up again, or is it take a little bit longer for people to come back from the beach these days?
No, it's a good point. I mean, ordinarily, you expect to see trading volumes certainly pick up in September. I always think October's probably one of the most interesting months of the year for the stock market. I think by then people are very much have their feet back under the table. They're very much focused on how things have gone. You've got good visibility in terms of corporate earnings and results. And as you well know, we have seen some quite significant sell-offs in October in years gone by. But my expectation would be that as we get into September, that activity will pick up. I think you'll see quite a lot of fundraising attempts in the investment companies sector. And bear in mind that those invariably take about 10 weeks or so to turn round. And obviously the clock is ticking into the year end as well. I think people will be quite keen to raise additional money. So all in all, I think September and October will be quite busy months for the market and for the sector.
Indeed. And of course, it's worth making, I think, the point that this has been a slightly unusual year in that we've seen the market go up every month so far, certainly the American market every month so far this year, without any kind of significant sell-off or correction. Nothing up to as much as 10% even. So there'll be some interesting development. That's quite unusual. And if for that to persist throughout the year would certainly be unusual. It only happened a very few times in history. So there's a lot to look out for, I think, in the coming weeks, both in terms of fundraising and results and the direction of the market itself. So, Simon, very good to have you back on the podcast. And we'll look forward to discuss all these exciting things in the weeks to come.
Thank you.
This week, unusually, I've decided to record a postscript to the weekly podcast, and that stems directly from my lamentable failure to be able to recall the history of the JP Morgan American Investment Trust, because it is an interesting history, and I think it deserves a little bit of a wider audience. The trust dates from 1881, I said in the podcast, but you did not originate, obviously, with that name. It originated as the Alabama, New Orleans, Texas and Pacific Junction Railways Company Limited. This described by the historian of the investment trust sector, John Newlands, in his book, Put Not Your Trust in Money, was a high-risk investment by anybody's standard, because that company was investing in railroad systems themselves rather than in railroad company shares and bonds, which was what a number of other early investment trusts decided to put their money in as a way of diversifying their holdings away from the UK. In any event, the Alabama, New Orleans, Texas and Pacific Junction Railways Company had two principal claims to fame. One is that its assets continue to fall in real terms for no fewer than 100 years, a somewhat remarkable, persistent, poor performance. And secondly, it became the recipient, retrospectively, of an action by the US Environmental Protection Agency in 1995, which was seeking damages for the costs of cleaning up a former creosote factory in Louisiana, which had originally been built in the 19th century, and which the EPA, this regulatory agency, it had the powers to seek retrospective compensation for the owners of that company, even if what they were doing at the time was legal. And that company was, of course, by then known as the Fleming American Investment Trust. So what had happened is that the original railroad company made a lot of losses, and that was disposed of, but it turned into something called the Sterling Trust during the First World War, which was raising money for the war effort and later became an investment trust in its own right. That in turn became the Fleming American Investment Trust in 1982, and later when JP Morgan acquired Fleming's business, became what is now known as the JP Morgan North American Trust. So that's how this thing evolved. So the antecedents of the trust, going back to 1881, were in this obscure and unsuccessful railroad company. And when the news of this lawsuit by the Environmental Protection Agency broke in 1995, it did lead to the shares in Fleming American Investment Trust, as it then was, moved to a big discount. And it was only a little later, the following year, when the board of the trust decided to settle with the EPA by paying them $4 million without admitting liability. I hasten to add that the shares returned to par. And later on that became the JP Morgan North American Investment Trust. So a little bonus this week, a bit of investment trust history, not without its interest. And my apologies again for not knowing this off the top of my head when the topic came up. Though, of course, Simon was right to know that it had been called the Fleming American Investment Trust from the time long before he joined the city. So I'm afraid I can exempt him from criticism of his lack of knowledge of that particular aspect of the saga.
This has been a Moneymakers Investment Trust podcast. These podcasts are independently produced and edited and are available on all leading podcast channels. You can sign up on the Moneymakers website, www.money-makers.co, to be notified every time a new podcast is available. Thank you for listening, and if you want more news, analysis, interviews and other investment trust content, don't forget to take a look at our premium service, the Moneymakers Circle, available now at the website.